Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, a podcast by Lundgren's Capital. Here we talk about what's happening in economies and financial markets from the developed and the developing world. It's a good Friday here in Manila, Peter. Quite rainy, but it's also a very eventful week ahead. Can you tell me what's something interesting you've spotted in the markets recently?
Yeah, sort of the small things that we now and then pick up and talk about.
Mhm.
This thing on Sunday, it's the two elections in two German provinces. It's
Mhm.
what you call prior Eastern German provinces. It's in Saxony in English, and Turing, that is Thuringia, I believe in English. It's not the biggest by far provinces in Germany, but it will underline something about the political landscape in Germany and across EU. It is very likely that the very left right-wing party AfD will gain around
Mhm.
30% of all the votes in both provinces, and that gives a difficult parliamentary situation in the two provinces. It means that another sort of center-right
Mhm.
party, CDU, is sort of where the prior German Chancellor Angela Merkel she originated from. They will need to form a government reaching to the very far left to form a government that has the majority against the far right. That is a very likely outcome.
Mhm.
Will it mean something for the investors on Monday morning? No, it will not. But it is exactly the same picture we see with a dysfunctional government on national level in Germany that is also reaching from Greens, SPD, and sort of liberal party FDP,
Mhm.
where there is a government. They are so sort of dysfunctional that reforms for Germany is coming into a sort of a stillstand. And we see that in France as well. Now, President Macron is trying to create a new government after the sort of surprise election. And so far,
Mhm.
it is not happening. And again, we see a very strong right wing, big minority against
Mhm.
a sort of a growing also left wing sort of minority. And this is a problem for Europe. And this is what we see on Sunday in these two German provinces will again underline these growing problems, political problems, standstill problems in Europe, in particular in the Eurozone. And this is, the 2 minutes or 2.5 minutes about what do I see sort of out there that not necessarily is a big thing for the financial market right now, but it actually implicates and underlines a problem for Europe, and it also is a partial explanation why we have a zero growth. So that is a thing going on Sunday, the 1st of September.
Mhm. Do you think it's a problem across mature economies, so to speak, or is it maybe a localized concern?
Well, so this sort of dividing
Mhm.
uh, political groupings in the society we observe in the US again in this
Mhm.
presidential
Right.
election up run. But it has been going on for 20 years in the US, and it actually
Mhm.
also been going on for quite a long time in Europe, and now it's sort of really surfacing as a problem. Yeah, so we see it many places, and
Mhm.
should that be a concern for investors? Yes, in the way that it makes it more difficult to maneuver. Growing risk that this political disagreement or split means that we get less reform work. Again, that is unhealthy for the sort of the macro level in economies. And again, that makes it more difficult for investors to maneuver. You need to be better, and you don't get the macroeconomic sort of uh, tailwind that normally is pleasant for investors. That is missing out. Yes. So yeah, a bit sort of a negative vibe, but it's just very important.
I understand. Yeah, that's an election, so it is important, especially for the people who are, the Germans who are going to be affected by that choice of leadership.
You're looking at sort of these more alternative issues, so to say.
Yeah, so actually, what I picked up over the past few days, and it actually goes back to the Euro area. So apart from the European Union and the United States, Canada has decided to join them in imposing high tariffs, import tariffs on China-made electric vehicles. So they're the third major trading bloc that's imposing a 100% import tariff on China-made EVs. And it's
Mm.
quite what I found really interesting is so Canada and US are imposing a 100% tariff, right? But
Yeah.
a report that I found from the Global EV Outlook from 2023 is that China-made EVs are so much cheaper that
Yeah.
even if theoretically you impose the 100%, right? So that's double the price. A common China EV is around 10,000 US dollars or cheaper, while the typical European made or American made EV is around 30,000 US dollars. So even if you
Oh,
double that price, it's still going to end up cheaper than what's made in the West. So what they're saying, what Canada, what the EU, and what the US are saying is that they're protecting their EVs
mm,
because China-made EVs are supposedly um, artificially cheap because of government subsidies. And of course, since a lot of EVs from China are also made by or assembled by state-owned enterprises, so the profit motive isn't as strong as, corporations or automobile makers elsewhere. But it's interesting to see how it ties together with global plans or global push to go greener in terms of reducing your emissions when you drive. That tariff from Canada is kicking in on October 1st. And apparently, there are reports that this will include even Teslas made in Shanghai, their factory there. So that's going to
yeah.
be quite a tricky situation to navigate. And of course, you'll also have to think that retaliation is maybe coming and likely so. What we've seen from the tariff war in the 2018, 2019 era is that when the Trump-led US raised tariffs on China-made goods, China was quick to respond with additional tariffs on US agricultural products like soybean and wheat.
Mm,
So actually, China has shown signs of retaliating against the EU. They're now saying that dairy products are under investigation coming from Europe. So that's likely where they'll fight back, so to speak. So
mm,
we are yet to see how they'll do that with American goods and maybe Canadian goods. But yeah, it's a bit disruptive or a lot disruptive in terms of global trade. And of course, the quest to be greener. China,
mm,
after all, accounts for 60% of global EV sales. So, not just, of course, they have a lot of residents at home, but also it's just a really, really huge consumer market. And the effect would be it's kind of hard to see how that tariff will make, of course, that will make China-made EVs somewhat unattractive, but considering the price disparity still, it's still gonna be hard to beat the very low prices of China-made EVs. So we'll watch out for that.
yeah.
China subsidizes manufacturing and incentivizes the purchase of EVs of its citizens. So, and that has created the downward effect towards prices overall. So it's a very interesting turn of events. So let's see how this tariff war continues. And I'm not sure how it will affect growth in China. But yeah.
Yeah. It was a bit, yeah, it was a bit, so it was really a tough move from Canada, yeah, as 100%.
Yes,
And I think there's another interesting sort of deeper perspective in the issue you raise is that China today actually represents 30% of the global manufacturing capacity. It is
right.
as extremely big. It's much bigger than European manufacturing capacity. And it's also something that is mentioned briefly in our comment quarterly, the China and ASEAN quarterly magazine we will issue in a few days.
That's
Uh,
right. We're releasing
yeah,
that very soon.
yeah. So this capacity, and the key is it's an overcapacity part of it. So
Mhm.
there's an enormous overcapacity in the manufacturing sector in China, and again, part of this manufacturing capacity is within what we call the state-owned enterprises, as the old government-owned or controlled manufacturing companies.
Mhm.
And the big issue is if Europe and in particular US had played the cards differently instead of imposing sort of import tariffs on goods, they should have demanded China or tried to convince China to close a big part of the state-owned companies with this extra manufacturing capacity that is
Mhm.
sort of leading to an this example on extreme competitive developments. All of a sudden, it is EVs, but next time it will be something else
Right.
that is basically filled up with this spare production capacity. So it will go on to other sectors. Is actually the outlook I believe we have.
Mhm.
So it is actually reaching very deep into global trade and how um, or the whole manufacturing sector is influenced in globally. So
Right.
fantastic, interesting topic, and of course it's harsh from Canada, but yeah, what happens. But as investors, we don't like trade tariffs. Yeah, we like global trade.
Yes.
Yeah, yeah.
Yeah.
Anyway,
Everyone's supposed to be better off with global trade, but with more, not with less. Yeah.
mm,
So, Peter, I'd like to talk about our outlook for the global markets. Of course, we know that from last Friday, the much awaited Jackson Hole Symposium basically saw the Federal Reserve Chairman Jim Powell say that the time has come for policy to adjust. Direct quote from him. So that's basically a confirmation of what everyone's been saying, that a rate cut is coming. But the question is now, as we did talk about it last week, is how much? What do you think about that, Peter? What did you read into Powell's words?
yeah, it's really interesting. Also to yeah, so to listen to Paul, and I'm still sort of looking out for
Hmm.
could they cut with 50 basis points here in the next time in September, on the 18th of September. Sort of the main scenario is still 25 per basis
Yes.
point, but there's no doubt that when Fed moves, they normally move fast. And it is of course up to the whole monetary committee, as the FOMC,
Hmm.
uh, for what they say. So it's not only what the chairman says, but I'm sort of in the league that I could lean towards 50 basis points. So where are you, Mel?
Right. So I actually think that the 25 basis point cut would be, the best way to test the waters, so to speak. We know that inflation in the US has been on its way down, but still not as close to 2%, the target, as they would like. But of course, seeing the number go down and go even lower every month is of course very welcome. So what they've been seeing is that some see that it's going to be a 25 and then a 50 maybe, and then another 25 in the next 4 months, so spread out until December. But I'm leaning towards at first a 25 basis point cut. And maybe that's how you follow through with your words, so to speak. So we always know that central bankers like their open mouth operations more than open market operations sometimes. And um the confirmation that came from the Fed chairman is a good it would be good to follow that up with the 25 first, maybe not to shock the market. We've always known that the 50 is a possibility, but it's always baby steps first, so to speak. But since you pointed out that the Fed does like to act fast, we shouldn't discount a 50 basis point cut either, right?
No, in the up run, apart from comments from different FOMC members, and it needs to be voting members, of course, it's always interesting to listen to these people. Then I look very much into the labor market data, actually. Depends very much what happens there. The worst thing that could happen for Fed is that all of a sudden they had sort of moved too late, meaning that the labor market is cooling too fast. And that would be they would be really criticized for having been too hawkish, so to say, and keeping the interest rate high too long time. So that is one thing. That is sort of the uprun to the coming meeting in 18th September. But of course, on the day, we will carefully listen to what do they say. Do they come up with 25 basis points? Say, okay, everything is looking okay, and we are going by plan. That would actually be positive in the way that the market expects 25 basis points. It won't change anything for investors or for in the financial markets. But the comments could actually be cheerful if it's what they're saying. If they come up with a 50 basis point cut, that should basically lift the stock market higher. But if they at the same time says we are nervous, then I think the outcome will be that investors will be disappointed and sort of the fear level will increase, meaning there will be a sell-off in the stock market and bond rates will go lower. So on the day, it is actually just as much a comments, and that is as usual. But this time the comments are really, really important, I think. So, but I have sort of, if I should bet my money somewhere, I would put a bit on the 50 basis points cut right now. But yeah, but a lot of things can happen and change until then. But it's interesting.
Yeah.
And as and we are sort of when we talked about today, and sort of we were funny enough sort of agreed on the fixed income market is interesting because something is happening in the second largest economy as well, in China.
Oh, yes.
There's it's fierce what's going on in the bond market there.
There are reports that there could be the Chinese government bonds could be on a rally, and interest rates, of course, are driven down. But there are fears that there could be a bubble bursting there. So want to pick your brains there, Peter. What does that typically mean? Of course, as a borrower, for example, you'd want interest rates to be lower, right? But it's not necessarily the case when you're talking about 100 billion worth of government bonds, right?
Yeah, it's a fascinating thing, and this is one of these typical moves in the Chinese financial markets. It is simply more volatile than in many other markets. What has happened is that every truckloads of investors they rushed into Chinese government bonds and bonds in general. So the 10-year interest rate now in as a Chinese treasuries is trading around to 2.25%. And that is compared to the US 10-year treasury yield that is at 3.85. And it is just, again, why have Chinese investors moved into the bond market in that case? And it's a bit sort of, in China, people just follow the trend much stronger than we're used to. And we see that in the stock market as well now. Then, to take an example, here in Europe, we like to talk about value stocks, meaning
Mm-hmm.
is a good value, and we talk about is the stock, is it underpriced, is it overvalued? When I speak with Chinese investors, they're saying this stock looks cheap now, it has gone down and actually compared to a lot of other things and blah blah. And then the reply from a typical reply that I mean see very often is, yeah, but the stock is going down, so why shouldn't I sell? And, and, and that is sort of the opposite thinking of what we have in Europe, and in between is US. Then investors in US are not as value focused as we are in Europe, but it certainly exists to a large extent. So the Chinese investors, they simply run after the trend and they continue until
Mm-hmm.
it sort of explodes. And now we have a situation in the Chinese bond market where this is happening. Even the central bank is out and warning against a
Yes.
bubble. And we are talking about the Chinese bond market is extremely big. It's second largest in the world.
Mm-hmm.
Um, and what is making the central bank nervous and a bit interesting as well that investors continue to stay long Chinese bonds is that the Chinese government and the local governments needs to issue truckloads of bonds for
Yeah.
this year. It is not to intervene in the market. One could ask oneself, why haven't they moved a bit earlier this
Mm-hmm.
year, as when the bonds sort of just went up? Uh, I think that is something to do with the decision taking and action making in among authorities in China. It's a bit slow in the monetary policy still. But there will be big bond issues to cover, and that is to cover budget deficits. So that is budget driven,
Right.
and it is partially also you could call slowdown driven as an economic slowdown driven. So
Mm-hmm.
they are issuing bonds, they can keep up the steam in the Chinese economy via sort of fiscal stimulus.
Mm-hmm.
Um, Mel, the big thing is, do we have sort of a roller coaster within domestic China again in the fixed income
Mm-hmm.
market that will hurt China's economy and all the, in particular, we probably think in the real estate sector as the first thing, yeah.
Mm-hmm.
So Chinese consumers, will they be afraid? What do we think? Yeah.
Yeah, so actually in our next week in China section in our website, we've seen that the Chinese stocks, for example, were down this week. So the continuing, jitters from the property sector crisis and of course the rising government debt, they continue to weigh on sentiment towards China, but we still continue to see that growth is really here. As we mentioned earlier in this podcast, China has remained to be the manufacturing powerhouse of the world. And that's not likely to a title that they're likely to lose anytime soon. So while there are these temporary setbacks as far as investor sentiment and as far as yields are concerned. There's still a lot of growth happening in China, albeit although it's a little slower than what they were used to, right?
Mm.
So a continued offering of bonds in the next 3 4 months is something that would in a way help the local and central governments manage its debt and finance what it needs to spend on at the time of low or slower economic activity. But as far as consumers are concerned, if this move helps prop up economic activity or stimulate economic activity, that's something that they should look forward to, right? Because it's what the Chinese economy needs to get a boost and get back slowly to where they were a few months or years ago, then that shouldn't be something they're afraid of.
Yeah, I agree that there's actually good fundamentals in China, and they are a bit
Mhm.
overseen. meaning also that generates some comfort in the stock market among investors. Should we put a price or risk tag on what is going on in currently in the fixed income market in China? And should there be a bubble that is bursting, or we see a quick rise in the 10-year yields? Then I'll say it will have a negative impact on the stock market, as a Chinese stock market, but it is limited. It is sort of a setback, and it would cost 5%. That could be on a day, or it could be during a week, but it's just a correction that is linked to a correction in the bond market, as it's a bit too hot right now. But the overall outlook, we agree. China is after all still going forward, and there are some pretty sort of stable to robust sort of growth across the country, also in what we call the private sector, and that's actually quite okay.
There was quite the talk about, there was some speculation that the government might be doing this to intervene. But yeah, as you pointed out, it's more likely to result in a correction more than a bubble bursting, which some are fearing. I mean, we've also seen market observers warning that, for example, in the US, that the inversion of the yield curve in the bond market was signaling a recession, but we saw clearly that that wasn't the case, and that everything's on its way back. So maybe we could see the same trajectory for the Chinese market. At least now it's a setback, but it's going to be temporary, and it'll normalize or even out in the next few weeks or maybe months.
Agree. Good. Should we jump to the sort of the risk outlook for the global financial markets, if we are changing our sort of overall views? What do we say in Asia? How are we feeling? Any change in our sort of risk view and opportunity?
We continue to see that it's quite a quiet time as far as economic news is concerned, apart from what we discussed earlier. But we continue to see that growth is here, and opportunities for investors are plenty, and we continue to remain optimistic that there's growth here, robust growth that would drive interest for investors globally, and relative to developed markets in the West. Growth is still performing much better here despite the risks that we see. And yeah, we do not change our view there, that we like what we're seeing, and despite the risks that we see, we continue to believe that this is a good place to invest in. How about in the US and Europe, maybe, Peter?
Yeah, again, sort of, we don't change our fundamental views very often, and that is from across the world. Still with the very fundamental view that the Fed rate cuts actually will add some positive impact on the financial markets. We all know they are coming. That's not a surprise. But when they arrive, they normally generate some reaction after all. And that is also, as we talk about in emerging markets, we like emerging markets. They will be supported by US rate cuts. And we like the depth, we like the duration, we like to have overweight in equity still. Do we see the macroeconomic sort of situation getting worse? Yeah, it is almost like every week that we see indicators of sort of slowdown indicators, and that means that we should be aware of this. But on the other side, many listed companies are very big companies, global companies, and they do not necessarily perform worse in under these macroeconomic sort of situations. And other areas we are very active is like we like alternative investments, particularly in non-listed companies, and they're doing fine. So the world still generates a lot of opportunities, and we actually doing we're quite comfortable with having risk, also still having more risk than average on the books. So yeah, this is again great outlook still. So
Yeah.
thank you for joining in this podcast, Mel.
We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by LearnGains Capital. Thanks for tuning in. For expert insights on the go, download the LearnGains Investor Insights app for free. For investors, we offer very exciting and high-quality alternative investment funds, including our top-rated Mutual China Fund. To know more, visit longbeanscapital.com.